Hi, this is Phil Greenwood from the UW-Madison School of Business. Here's our next in a series of lean finance slides. We want to talk 5 or 6 sessions on acquiring business financing, just some background information, and also a strategy for seeking financing. Before we get started, I like to talk about some general principles that I like to introduce and make sure that I believe are real valuable in looking for financing for small businesses, whatever the stage and growth expectations and such. First off, you always have to remember that one of the first principles when dealing with investors is that they are guided by this balance between greed and fear. Greed being that everybody likes to make some money, so that's a driving force, but also the fear they can lose everything. So there's this balance that investors have to rationalize whenever they make investments. This can vary quite a bit depending on the economy, depending on confidence, and so on, and then depending on the individual investment. We also like to call that, instead of just calling it greed and fear, since those terms are a little onerous, we like to call it risk versus reward. Risk being that investors are worried about what is the risk that I plan to that I can take in order, what's the level of risk tolerance that I have, but also balance that with what's the reward I would be required that I require in this investment in order to offset that risk, or at least to compensate me for the risk I'm taking. Second principle I like to always talk about is the financeability of your business, and specifically how you finance your business at the startup and early stages, how that can affect things long term. Companies love to obtain, especially equity financing in the form of common stock, at as high a valuation as they can, or take on certain types of investors, like family and friends, because it's easy to get money from them sometimes. Well, that type of financing or too high of a valuation can have a dramatic impact on the ability for you to raise money in later rounds, especially when you start seeking money from venture capitalists, more sophisticated angels who may not be disposed of wanting to invest in company where a lot of family members are involved or valuations are too high. The third principle that we always look for is that optimal or ideal financial model in a business, and it can really be summarized through this. The investors love businesses that can buy their product or service at a very low price or low cost, sell it at a really high price, creating a great margin. They have the ability to collect early from customers, if not a cash business, close to it, and then the ability to pay their vendors later so that they can use that float in the financial management of their business. Now, a lot of businesses can't meet those needs, but if you can meet somehow, when you show your business model, present it, if you can meet this criteria, it'll make you a very attractive candidate for investors.